Okay, we're going to take some time and go through several problems at the end of Chapter 8 so we can work it through together. Let's start with Exercise 8-2. On January 10th, Allison Milo uses her Crawford Company credit card to purchase merchandise from Crawford Company for $1,700. On February 10th, Milo's billed for the amount due of $1,700. On February 12th, Milo pays $1,100 of the balance due. On March 10th, Milo's billed for the amount due, including interest at 1% per month of the unpaid balance. So our job is to prepare the journal entries that Crawford would show for the credit card transactions and the sale. We'll start with the January 10th. We'll move on to the February 12th and the March 10th. So let's look and see. January 10th, she uses the credit card to purchase goods for $1,700. February 10th, she's billed. February 12th, she pays $1,100. And then on March 10th, there was interest on that. So let's take a look at this and see that we'll start with the $1,700 accounts receivable, Milo, $1,700, and we'll show that as a sales revenue credit for $1,700. Then we show that the company received cash on February 12th, and we're going to offset that with Milo's accounts receivable for $1,100. Then we will show the interest increase by taking 1% of the outstanding balance of $600, which would be $6. So we'll increase the accounts receivable for Milo for $6, and we'll credit interest revenue for $6. So basically, as you can see here, her credit card will be increased for that $6 for the interest. We're not going to show that as a sales revenue item because it's purely the interest revenue as a result of extending that balance for another month. Now let's go back and let's look at another problem, 8-3. At the beginning of the current period, Griffey had balances in the accounts receivable of $200,000 and in allowance for doubtful accounts of $9,000, which was a credit. During the period, it had net credit sales of $800,000 and collections of $763,000. It wrote off as uncollectible accounts receivable of $7,300. However, a $3,100 account previously written off as uncollectible was recovered before the end of the period. Uncollectible accounts are estimated to total $25,000 at the end of the period. So we need to show the journal entries to record the sales and collections. Then we need to record the journal entry to prepare the write-off on collectibles during the period. So we see here we have net credit sales of $800 and we have collections of $763, and we need to show an uncollectible of $7,300 and then correct the $3,100 that was previously written off. And in addition, we're going to need to show that the uncollectible accounts need to be estimated at $25,000 at the end of the period. So we're going to need to determine what our bad debt expense is, we'll need to adjust our allowance for doubtful accounts to show that $25,000 at the end of the period after we take into account some of these entries here. So let's look at this problem. This is a great one to go through to see the process. As you see here, the first thing we'll do We'll debit our sales, accounts receivable, we'll debit, the first journal entry is to record our sales. So we'll debit our accounts receivable for $800,000. We'll credit our sales revenue for $800,000. Then we received collections of $763,000, so we'll debit our cash of $763, reduce our accounts receivable for $763. Next, we wrote off an account, and so we're going to debit our allowance for doubtful accounts for $7,300 and credit our accounts receivable for $7,300. Then there was an account that we did collect that we had initially written off, so we'll need to reinstate that accounts receivable for $3,100, credit our allowance for doubtful accounts for $3,100, and then receive the cash by debiting our cash for $3,100 and crediting that accounts receivable. Now we need to determine if we need in our allowance $25,000 for the end of the year. We need to look at how we go about getting that balance of $25,000. So we began the period, let me just confirm where it said we began the period, yep, with $9,000 as a credit. So if we show a T account and we know we want to end up with $25,000, so we have to plug in a number. We show our balance of $9,000. We show we wrote off $7,300. Then we're going to go back and show we recovered that $3,100. So basically, we're taking these journal entries from above and posting them. If we know our ending balance needs to be $25,000, that means we need to show a debit for allowance, or a debit for bad debt expense of $20,200, and we will credit our allowance for doubtful accounts of $20,200 because that gives us what we want at the end of the month, a $25,000 credit in our allowance for doubtful accounts. Okay, let's look at another problem here. Okay, let's look at 8.6, exercise 8.6. On December 31st, when its allowance for doubtful accounts had a debit balance of $1,400, Hunt Company estimates that 9% of its accounts receivable balance of $90,000 will become uncollectible and records the necessary adjustment to allowance for doubtful accounts. On May 11th, Hunt determined that J. Beard's account was uncollectible and wrote off $1,200. On June 12th, Beard paid the amount previously written off. So we need to create the journal entry. So again, the allowance starts with a debit balance of $1,400. So if Hunt estimates 9% of its accounts receivable is going to be uncollectible, we're going to need to adjust our allowance for doubtful accounts needs to have a credit balance of $8,100. So if we're starting with a debit balance, we're going to need to adjust that. So let's look at exercise 8.6. And you see here, we are going to show a debit balance. We'll start with our $1,400 debit balance, but then we're going to need to add $8,100 to this because we need to end up with $8,100 at the end of the period. So we'll need to take our 9% of our accounts receivable, of our sales, $90,000, plus add to that our $1,400, so we can end up with a balance, a credit balance of $8,100. So we would debit our bad debt expense of $9,500, credit our allowance for doubtful accounts of $9,500. Then we determined Beard's account was bad. We are going to clear out his account, write it off. So we debit our allowance for doubtful accounts of $1,200. We credit the accounts receivable for Beard of $1,200. Then he pays it. So we need to reinstate his accounts receivable as a debit for $1,200, credit back our allowance for doubtful accounts of $1,200, and then receive the cash as an increase in cash for $1,200, and then zero out his accounts receivable or credit that for $1,200. Let's look at a couple more. Okay. Let's look at this one. I'm not going to do that one. Let's take 8.2. On December 31st, Weiss Imports reported this information on its balance sheet. So it showed the accounts receivable of $600,000 and our allowance for doubtful accounts of $37,000. So as we know there, we would show on our balance sheet the net receivables there of $563,000. During 2014, the company had the following transactions related to receivables. We show our sales on account, $2,500,000, sales returns and allowances, $50,000, collections of $2.2 million, write-offs of accounts receivable deemed uncollectible, $41,000, and recovery of bad debts previously written off of $15,000. So each one of these transactions we need to prepare journal entries for. So as we look here for our journal entries, we'll start with our credit sales. And so we'll start with a debit to accounts receivable for $2.5 million and show our sales revenues for $2.5 million. Now we had $50,000 returned, so we'll show that as a sales returns and allowances and credit our accounts receivable for $50,000. From that, we'll debit our cash to show what's collected, $2.2 million, and credit our receivables of $2.2 million. Now, number 4 states that we wrote off accounts deemed uncollectible of $41,000. So we will debit our allowance of $41,000 and we'll credit this accounts receivable of $41,000. And then some of those that we wrote off, they ended up paying. So we'll have to reinstate those accounts, debit our accounts receivable, credit our allowance, and then debit our cash and credit those receivables that did finally pay. Now the next step asks us to enter the balances in accounts receivable and allowance for doubtful accounts. So we need to determine our ending balances. So what we'll do here is create T accounts, create T accounts and show the beginning balances, and then from there where we have an ending balance. So we started with a balance of $600,000. We added our credit sales. We credited our returns. We also, when we received the cash, we credited receivables then. When we wrote off some accounts, we credited it, but then when we reinstated those accounts because they were paying, we debited those receivables back and then credited them when they finally paid. So if we take all of our debits, subtract our credits, we have an ending balance here in our receivables of $809,000. We're going to do the same with our allowance for doubtful accounts. It said we started the period, let me make sure, with allowance for doubtful accounts, $37,000. So we're going to start with our credit there. Then from there, the ones we wrote off, we debit. Then when we reinstated them, we credited them back. So we end up with an ending balance in our allowance for doubtful accounts of an $11,000 credit. Now it goes on to tell us, prepare the journal entry to record bad debt expense for 2014, assuming that aging the accounts receivable indicates that estimated bad debts are $46,000. So they're estimating the bad debts to be at $46,000. So in order to do that, what we need to do is show if the bad debts are at $46,000 and we currently have $11,000 as a credit for our doubtful accounts, we'll need to do a journal entry for $35,000. So our new balance can be $46,000 as a credit in our allowance for doubtful accounts. So we'll need to debit our bad debt expense for $35,000, credit our allowance, so that way that allowance will end up having an ending balance of $46,000. So I hope this has helped you. If you have any questions, we will be meeting